Welcome to Personal Finance Deep Dives, where we help you make your money work for you. Today, we are taking a crucial deep dive into the free application for federal student aid, or FAFSA. For anyone considering higher education or, for parents navigating that path with their children, the FAFSA is truly a pivotal step. We're going to unpack its core purpose, precisely how it determines financial aid, explore the myriad types of assistance it unlocks, and critically examine the recent changes. Changes that have both aimed to simplify the process and, well, at times, introduce some unexpected complexities during its rollout.
That's right. I often tell families the FAFSA is so much more than just another form. It really does act as the essential gateway to making college affordable for millions of students and their families across the United States. So many people mistakenly assume they won't qualify for any aid because of their income, but that's a common and
Right.
often costly misconception. It's something we absolutely want to clear up for you today. Let me assure you, based on my experience, almost every family with a college-bound child should seriously consider completing it.
Okay, let's unpack this then. We're going to start right at the beginning. What exactly is the FS and what's its primary purpose? We know the acronym stands for Free Application for Federal Student Aid, right? But what does it actually do for you when you sit down and fill it out? What's its real power here?
Well, at its core, the FS is the official application that students or their families use to apply for financial assistance for college from the federal government. That's the baseline. But its reach extends far beyond just federal programs. And this is where it truly gets interesting for most families. States, individual colleges and universities, even many private scholarship programs, actually rely on the very same information you provide in this single application. My team and I, we really see it as the central hub for financial aid eligibility. Its main goal is to determine how much financial aid a student qualifies for. And that encompasses both aid that's based on your financial need and, importantly, aid that is not based on need. It's a comprehensive look.
Okay, so it's not just about getting federal money then. It sounds more like a universal key almost, like a master application that unlocks all sorts of different aid programs. Is that a fair way to put it?
Precisely. That's a powerful distinction, and it's exactly why it's so critical to complete, even if you think you won't get need-based aid. You're right. It determines your eligibility for a really wide array of programs. This includes key federal need-based grants like the well-known Pell Grant, which can be a game changer for eligible students, and federal supplemental educational opportunity grants, often called FEOGs. It also determines eligibility for subsidized federal student loans. Those offer very favorable terms because they are based on your demonstrated financial need. But the benefits don't stop there. Most students, regardless of their family's financial situation, can still qualify for unsubsidized federal student loans. And for those looking to earn money while studying, it's also the essential gateway to federal work-study programs. Beyond federal aid, the FAFSA is also key to unlocking state-based financial aid grants, scholarships, maybe even state-specific loan programs. And critically, it's absolutely essential for school-based financial aid. Think need-based grants and scholarships offered directly from the college itself. What's fascinating, and something I always emphasize to families, is that many schools even require the FSA to be on file before they distribute any merit aid awards, even if that aid isn't directly tied to your financial needs, like a prerequisite for just being considered.
Right. So even if you think, oh, my family's income is too high or, we make too much money to qualify for anything, it still makes absolute sense to fill it out. Why is that often the case? Why do so many families fall into that trap of just assuming they won't qualify?
That's such a critical point, and it's a misconception we hear far too often. Many families simply dismiss the idea of applying because they believe their income is too high. But that's frequently a costly mistake. It can literally prevent them from accessing valuable resources they might otherwise get. The truth is, regardless of your family's earnings, you may indeed be eligible for some form of financial assistance. This could include federal aid, state aid, school-based aid, and yes, even those merit-based scholarships you mentioned. For instance, many families qualify for unsubsidized federal student loans, regardless of income. And those loans generally offer much better terms than private loans, which we'll definitely get into later. In fact, our data shows that the vast majority of families with a college-bound child are eligible for some form of federal financial aid for college. It's not just for low-income families. It truly has broad applicability. It's an indispensable step for almost everyone.
That brings us to takeaway number one. Don't let assumptions about your family's income stop you. The FAFSA is more than just a federal form. It's the only universal key to unlock not just federal, but also state and even school-specific aid and merit scholarships, often regardless of your financial need. Missing it means potentially leaving thousands on the table.
Okay, so once you fill out the FSA, how does the system actually figure out how much aid you qualify for? I know there's something called the Student Aid Index, or SAI now. Can you explain what that is and how it functions in this whole process?
Certainly. The FSA asks a series of very specific questions about both the parents and the student's income and assets. It also considers other factors, like the number of children in the family who will be attending college, or maybe other family members they support financially. All of this data is then crunched through a specific formula, one set by Congress actually, to come up with what is now called the Student Aid Index, or SAI. This SAI is a key factor, maybe the key factor in determining your financial need. It's essentially the number that colleges use to calculate how much aid you might need. For instance, the SSI's methodology assumes that a certain percentage of your assets should be available to help cover college costs each year. Specifically, it assumes that 20% of a student's assets should be available for spending in any one college year, while only about 5.64% of the parents' assets are expected to be available.
Whoa, 20% versus just over 5%. That's a big difference.
It is. It really shows how student-owned assets are viewed as much more immediately available for educational expenses compared to parental assets. So, if a student has $10,000 in a savings account, the FSA expects $2,000 of that to contribute to college costs that year. But if parents have $10,000 in taxable savings account, only about $564 is expected. It's quite weighted.
That's a fascinating detail. So, what exactly counts as assets when we're talking about this SAI calculation? And maybe more importantly, what doesn't? Are we talking about absolutely everything you own, or are there specific exclusions families should definitely know about?
Good question. And this is another area where families might make assumptions that lead them to think they won't qualify, when maybe they could. Assets generally include liquid funds, like bank accounts, checking and savings, and various investments, like taxable brokerage accounts with stocks or mutual funds, things like that. However, it's very important to note what's excluded. The value of retirement accounts, think 401ks, 403bs, IRAs, those are excluded from this calculation. That's a huge relief for families who've been diligently saving for retirement. Similarly, life insurance policies and annuities are also excluded, which is crucial for many families' long-term financial planning. And maybe the biggest relief for most families, especially with rising home values, is that any equity in your primary family home is also excluded.
Oh, wow. Okay. The house value doesn't count against you.
Exactly. Your primary residence's value won't be counted. So, your SAI, determined by this carefully selected financial information, then dictates whether you qualify for need-based aid, non-need-based aid, or, maybe a combination of the two. Understanding these exclusions can sometimes really change the picture.
That clarifies a lot. So let's dive into the types of aid that are based on financial need, starting with grants. What exactly are grants, and how do they really work in practice?
Right. Grants are often considered the best type of aid because, unlike loans, they generally don't need to be repaid. Think of them as gift aid. They are need-based, meaning your SAI is the primary determinant. First, we have federal Pell Grants. These are the main federal grants for college students. They're specifically intended for students who demonstrate exceptional financial need, meaning your SAI is quite low, often below a certain threshold. They are primarily awarded to undergraduates, though some specific teacher certification programs might also be eligible. For the 2024-25 award year, for example, the maximum award amount was $7,395. And it's important to understand that a college or university's financial aid office is the one that determines the exact amount you qualify for. They look at your family's SAI and the school's overall cost of attendance. So lower SAI, higher school cost, potentially more Pell Grant up to that maximum. These can cover tuition, fees, books, even living expenses. Then there are Federal Supplemental Educational Opportunity Grants, or FCOCs. These also don't need to be repaid, which is great. However, a key difference is that they are only available at certain schools.
The funds are limited, often allocated directly to institutions, so not every college participates or has enough funds for everyone who qualifies. The amounts can range between, say, $100 and $4,000 per year. And like Pell Grants, they're specifically for students with few other financial resources, really targeting those with the highest need. Often, these are distributed on a first-come, first-served basis by the schools themselves, which really highlights again why submitting the FAFSA early is so important.
Absolutely. Free money is always the best option. But what about subsidized loans? They sound like a pretty good deal, too, especially with the government helping out with the interest part. How do they compare?
They are indeed a very good deal, and they represent a significant advantage compared to other loan types because of that government subsidy you mentioned. Federal direct subsidized loans are subsidized by the government. The major benefit is this: you will not be required to pay interest on them while you are enrolled in school at least half-time. and for an additional grace period of 6 months after you graduate. The government literally covers that interest for you during those periods.
So the balance doesn't grow while you're studying.
Exactly. That's a crucial benefit because it means the loan balance doesn't inflate while you're focused on your studies, keeping your overall debt burden lower from the start. Loan amounts range from $3,500 to $5,500 per year, depending on your year in school and dependency status. But important note, these specific subsidized loans are not available for graduate study. They're reserved strictly for undergraduates who demonstrate that financial need.
Okay, got it. And then there's work study. How does that fit into this picture of need-based aid? What does that look like practically for a student?
Federal Work Study is a program that makes paid part-time jobs available through participating colleges and universities. Both undergraduate and graduate students may be eligible, providing a way to earn money for their educational expenses while actively pursuing their studies, rather than taking on more loan debt. The unique aspect here is that the federal government actually subsidizes a portion of the student's wages, often around half up to a certain amount allocated to the student. This makes it attractive for employers on campus or at approved nonprofit organizations off campus to hire these students. It's not just about the money either. It often offers valuable work experience, sometimes related to their field of study, alongside the financial support. Students receive a paycheck for hours worked, just like any other job, and crucially, those earnings don't count against them on future FAFSA applications, which is a nice bonus.
That brings us to takeaway number 2. The FAFSA utilizes your financial information to calculate a Student Aid Index, SAI, which in turn determines your eligibility for valuable need-based aid programs such as Pell Grants, FCOG, direct subsidized loans, and federal work study. Each offers a distinct way to support your education, often without requiring repayment or with that helpful deferred interest. Okay, so we've covered the aid that's explicitly based on financial need, which is a huge part of the FAFSA's purpose. But what if your SAI indicates you don't qualify for those? Are there still federal options available that aren't tied to your financial situation? Because, like you said, people assume if they don't get a Pell Grant, they're out of luck.
Absolutely, and this is precisely where many people miss out if they make that assumption. Even that your financial situation doesn't demonstrate a need for subsidized aid, there are significant federal options available. These are not tied to your financial situation, making them broadly accessible to almost everyone. First, we have direct unsubsidized loans. These are similar to subsidized loans. They're federal loans with a fixed interest rate, but they have one key difference. The government doesn't pay the interest that accrues while you are in school or during the 6-month grace period after graduation.
So the interest starts building up right away.
Yes. If you don't pay that interest during this time, it will be added to the principal of the loan that's called capitalization. This means your loan balance literally grows larger before you even start repayment, and you'll then pay interest on that new, higher amount. Schools can offer these loans as part of a financial aid package, regardless of a family's financial situation, so almost every student is eligible. For dependent undergrads, there are limits, a maximum of $31,000 in combined subsidized and unsubsidized loans over their undergraduate years, with higher limits if parents are ineligible for PLUS loans. Then there are federal PLUS loans. These loans are specifically designed for parents of dependent undergraduate students or for graduate and professional students themselves. Like unsubsidized loans, they are not subsidized by the government. Interest begins to accrue immediately from disbursement. If that interest isn't paid while the student is in school, it gets capitalized, added to the principal, increasing your overall debt. PLUS loans also have a credit check requirement, unlike the direct subsidized or unsubsidized loans, so credit history can impact eligibility here.
So these unsubsidized and PLUS loans start accruing interest immediately, unlike the subsidized ones. That's a really important distinction for borrowers to grasp. Definitely impacts the total cost. Are there any other non-need-based grants that might surprise people?
Yes, there's one notable grant that falls into this category, specifically aimed at a particular career path. The Teacher Education Access for College and Higher Education, or TEACH grants. Students who are training to become teachers can qualify for these grants up to $4,000 per year, even if they don't meet traditional need-based criteria. However, and this is a very significant condition, I cannot stress this enough, there are strings attached. To keep it as a grant, you must take certain classes related to teaching, maintain a specific GPA, and importantly, you must agree to work for at least 4 years within 8 years of graduation in a high-need field at an elementary or secondary school or an educational service agency that serves low-income families.
Okay, so there's a service commitment.
It's a serious one. If you fail to fulfill these requirements for any reason, the grant money you received converts into a direct unsubsidized loan. meaning you'll have to repay it with interest retroactively from the date you got the money. So it's absolutely critical to understand that commitment before accepting a Teach grant. It's really a loan with a potential forgiveness path.
It sounds like federal loans, even the unsubsidized ones, still have some really solid advantages over going straight to private options. Can you elaborate on why that's such an important point? Why are federal loans generally preferred?
That's a crucial point and is one we emphasize strongly. Federal loans, whether subsidized or unsubsidized, tend to be significantly less costly and offer far greater security than private student loans. This is often due to their fixed interest rates set by Congress annually, which are generally lower than what many private lenders offer, especially if you don't have perfect credit. Beyond just the cost, federal loans also offer significantly more flexible repayment options. We're talking about income-driven repayment plans that adjust your monthly payments based on your income and family size. These can be a lifesaver if you face financial hardship after graduation. They also come with various deferment and forbearance options, ways to postpone payments if you face unemployment, economic hardship, or medical issues. And critically, federal loans come with potential loan forgiveness programs, like public service loan forgiveness or teacher loan forgiveness, that private lenders simply do not offer. Because of these distinct advantages, we generally recommend exhausting all your federal loan options first, up to your maximum eligibility, before you even begin to consider private loans. Private loans should really be a last resort.
That brings us to takeaway number 3. Even if you don't demonstrate financial need, federal programs like direct unsubsidized loans, PLUS loans, and Teach grants offer vital support. And remember, these federal options almost always come with more favorable fixed interest rates, flexible repayment options, and crucial borrower protections compared to private loans. So we've got a good handle on what the FSA is and why it's so important. Now, let's get practical. How do you actually apply for it, and what's the typical timeline students and families need to keep in mind?
Right, the application process itself. While it can seem daunting, it's relatively straightforward once you know the steps and dates. Let's start with when to file. The AFS officially becomes available to the public on October 1st every year for the upcoming academic year. So for the 2025-2026 academic year, the AFS opened on October 1st, 2024. This has been the date since the 2017-2018 academic year. The Department of Education shifted it from the old January 1st date to align better with college application cycles, giving you more time to figure out aid before committing. And it's incredibly important to note, some financial aid, particularly certain state and school-based grants or limited funds, is provided on a first-come, first-served basis.
So getting in early really matters for some pots of money.
It absolutely can. Delaying can literally mean missing out on available funds because they've already been given out to earlier applicants. So submitting as soon as possible after October 1st is highly recommended. Regarding the financial info you need, the FAFSA uses what's called prior year tax information. So for the 2025-26 academic year, you'd use your 2023 tax information. This change, also from 2017-18, is really helpful. It allows you to use the IRS data retrieval tool built right into the FAFSA. This securely and automatically imports your federal tax info directly from the IRS. It eliminates a lot of manual entry, reduces errors, and speeds things up because your 2023 taxes would already be filed by October 2024.
That makes a lot of sense. Using older tax data, applying early key strategies. How do you actually go about filling out the form itself? Are there different ways to do it, and any warnings?
Yes, you have a few official options, but I cannot stress this enough. Only use the official federal government website or app. Your primary and most recommended option for filing is the official website, studentaid.gov. That's the only official portal. Be vigilant because some unofficial websites look legitimate, but they often charge a fee for helping you with the FAFSA.
But the F stands for free.
Exactly. The F in FAFSA stands for free, so you should never ever pay to complete it. Those sites are essentially scams. You can also conveniently complete it using the Miss Student Aid mobile app, which is pretty user-friendly. And if you prefer paper or need a PDF, you can call the Federal Student Aid Information Center at 1-800-433-3243 to get a PDF form. But the online options are generally the quickest, most efficient, and most accurate, largely thanks to that IRS data retrieval tool integration.
Okay, studentaid.gov, got it. What happens after you hit submit? What kind of report or confirmation do you get back?
After you successfully submit the FAFSA, you'll get what's called a Student Aid Report, or SAR. The SAR is basically a summary of all the data you provided. It also includes your potential eligibility for different aid types, and most importantly, your calculated Student Aid Index, SAI. This report confirms your application was processed. It's also where you check for any errors that might need correcting. Then, an electronic version of the SAR, called an ISER, Institutional Student Information Record, is made available to all the colleges you listed on your FAFSA. It also goes to state agencies that award need-based aid. Think of the ISER as the official data file your chosen schools use to put together your financial aid offer.
Speaking of listing colleges, I remember hearing concerns years ago about the order you listed schools potentially impacting aid offers. Is that still a thing people need to worry about?
That's an important historical note. I'm glad you brought it up because it used to be a real concern, causing a lot of anxiety. Historically, there was concern that colleges could potentially use your FAFSA position, the order you listed them, to make decisions about admission or aid. However, to fix this and make it more equitable, the U.S. Department of Education changed the FAFSA back for the 2016-2017 academic year. Now, schools are explicitly prevented from seeing which other schools are listed on your application.
Oh, good. So the order doesn't matter anymore.
Correct. You can list your preferred schools in any order without fear of it negatively impacting your aid offers from other institutions on the list. You can list up to 10 schools initially. If you're applying to more than 10, there are ways to send your info to additional schools after the first batch is processed.
That's a huge relief.
Yeah.
But what if your family's financial situation changes significantly after you submit the FAFSA? Like if a parent loses a job or their big medical bills, can you appeal for more aid, or are you stuck with that prior year snapshot?
That's a crucial question, and the answer is yes. You absolutely can and should appeal in those situations. Students can file what's often called a special circumstances appeal or a professional judgment request directly with their college's financial aid office. This process is specifically designed for situations where your current financial reality is significantly different from the information on the FAFSA. Things like a parent losing a job, a major reduction in income, unusually high medical expenses not covered by insurance, or other unforeseen hardships. Maybe there was a one-time bonus in the tax year used that isn't reflective of current income. The exact appeal process can vary a bit from school to school. They have their own procedures and documentation requirements, but it's always worth exploring. Financial aid offices have the authority to make adjustments to your aid package based on documented changes. Don't assume your initial offer is set in stone if things change drastically. Advocate for yourself.
That brings us to takeaway number 4. The FSSA application process is designed to be accessible and it's annual. You should apply early using only official channels, carefully review your student aid report, and know that you absolutely can appeal if your financial circumstances change a vital safety net.
Even with the recent simplification efforts, filling out any major financial form can be, well, a bit daunting. And the FSA is no exception, especially given some of the recent rollout hiccups. So I want to walk you through some common mistakes we see families make. These can unfortunately delay your application or even impact your eligibility, but they're mostly avoidable with careful attention. Let's look at some common mistakes to avoid. First, name and social security number. You absolutely must ensure the student's name and social security number are entered exactly as they appear on the student's official social security card. Even a small typo here can cause major processing delays or rejection. Second, be very careful not to confuse the parent section with the student section. They're distinct parts. Make sure the right income, assets, etc. go in the right place. Mixing them up can really skew your SAI. Third, calculating the household size often trips people up. Be sure the total includes the parents and anyone else they support more than half of the time other dependent kids, maybe elderly relatives living with them. And importantly, if the custodial parent is remarried, you must include the step-parent in the household size and report their finances too. That's federal policy. Fourth, don't confuse taxes paid versus taxes withheld. These are different numbers on your tax return. Taxes paid is your actual tax liability for the year. Taxes withheld is what came out of paychecks. Honestly, the best way to avoid this is using the IRS data retrieval tool whenever possible. It pulls the correct numbers directly.
Right, just let the computers talk to each other.
Exactly. Fifth, remember that 0 is a number. If the answer to a question is truly 0, or if it doesn't apply, you must type in a 0. Don't leave it blank. Blank fields can cause processing errors. Sixth, when asked for your degree certificate, fill in what you're working toward for that specific academic year you're applying for, like bachelor's degree. Seventh, don't skip the gender question. Federal rules currently require the answer to match the student's legal documentation, usually the birth certificate, for identification matching. And finally, crucially, sign the application. Sounds obvious, but it gets missed. If you're a dependent student, both you and one parent must sign. If filing online, you use your individual FSA IDs, the student has one, the parent has their own separate one. Both are needed. An unsigned FAFSA won't be processed at all when it comes to getting help. Always read the instructions carefully. Check the extensive FAQ section on studentaid.gov. You can call the Federal Student Aid Information Center at 1-800-4FED-AID. That's 1-800-433-3243. And of course, your school's financial aid office is an invaluable resource. They can help with nuances specific to their school and guide you on appeals. And remember, you can always log back into your FSA at studentaid.gov using your FSA ID to review or make corrections if needed.
Those are really valuable practical tips. It definitely sounds like attention to detail is paramount. So many little things could trip you up. Now let's talk about the elephant in the room, the big changes, the FAFSA Simplification Act, and the, well, significant challenges during its rollout for the 2024-2025 year. What was supposed to change for the better, and what issues actually cropped up?
Yeah, this is a complex but incredibly important topic. The FAFSA Simplification Act, passed by Congress back in 2020, really brought about some major improvements intended to streamline things and expand access. The intentions were definitely good. Let's look at the positive changes from simplification first, because there are real benefits. One of the biggest wins is the reduced number of questions. The old FAFSA was notoriously long, like 108 questions. The new FAFSA is much shorter. Most families now answer somewhere between 18 and 36 questions. That makes it quicker, less burdensome.
That's a huge difference.
It really is. Another key improvement is the mandatory IRS data retrieval tool. It's now required for most applicants. It directly links your FAFSA to the IRS, automatically pulling in tax info. This cuts down on manual errors dramatically. The act also led to removing certain questions. Questions about selective service registration for males and past drug convictions were removed, streamlining things and broadening eligibility slightly. And crucially, there's been expanded Pell Grant eligibility. Changes to the underlying calculation methodology for the SAI mean that nationwide estimates suggest about 610,000 additional low-income students will now qualify for a Pell Grant. And an additional 1.5 million students are expected to qualify for the maximum Pell Grant amount for 2024-2025. That's a significant expansion of access to crucial grant aid. There's one notable new reporting requirement. Students now have to report the value of their family business or farm, which was previously excluded under certain conditions. That was a change some found challenging. Now, despite these excellent intentions, the challenges and delays in the 2024-2025 rollout were substantial. It caused widespread frustration.
Yeah, we heard a lot about that.
The primary issue was technical errors and glitches. The rollout of the new system for 2024-2025 was just plagued with technical problems. This caused huge delays in getting that critical student aid data, the ICERs, to colleges. Instead of schools getting data by late January, the first batches didn't arrive until mid-March. This pushed back financial aid award letters by weeks, even months, creating a massive crunch for students trying to make college decisions. This also had a disproportionate impact. These technical hurdles hit students from disadvantaged groups and low-income backgrounds hardest. They might not have the same resources or support to navigate the glitches and delays. There were also specific FSA ID verification issues for some families, particularly those with parents without Social Security numbers, causing further delays. The severity led to a leadership change. The head of federal student aid resigned amidst the issues, and as a direct result, many universities nationwide extended deadlines. The typical May 1st decision day got pushed to May 15th, or even later at many schools, just to give students time to actually get and compare their aid offers.
Looking ahead to 2025-26, the Department of Education tried to get ahead by opening the FS earlier on November 21st, 2024. However, another change announced in early 2025 for the 2025-26 form is the removal of the non-binary gender identification option to comply with a new executive order defining gender as strictly male-female for federal forms. So policy continues to evolve things.
Wow. So it really sounds like a mixed bag. Great intentions, some real positive changes baked in, but a very challenging and frustrating execution during that initial rollout. What do you recommend students and families do now amidst these ongoing changes and potential frustrations? What's the best advice?
My advice really boils down to a few key things. Don't panic, don't wait, and keep in touch with your financial aid office. First, complete the FAFSA as soon as you can, ideally shortly after it opens each year. Don't let news of past delays deter you from submitting your application promptly. If you encounter technical challenges beyond your control, or if your family situation changes significantly after you submit, actively communicate this to your college's financial aid office. Be proactive. Gather all your necessary financial information beforehand, tax returns, bank statements, investment records. Be organized. Also, know that because the housing question was temporarily removed for 24-25, you might need to confirm your housing plans directly with your school, as they might collect that info separately for budgeting purposes. Financial aid offices nationwide understand the situation. We're all working incredibly hard to communicate updates and be as flexible as possible with deadlines. We're all navigating this new landscape together. Proactive communication from you really helps us help you.
That brings us to takeaway number 5. While greatly simplified in its design, the FAFSA process has faced significant challenges and delays in its recent rollout. This requires diligence in avoiding common mistakes, and it also demands patience and proactive communication with financial aid offices as everyone navigates this new system together. Okay, let's shift gears slightly. How do external scholarships fit into this picture? If a student gets a scholarship directly from an outside organization, maybe a local community group or a company, does that typically impact the federal aid they get through FAFSA? Could it reduce their Pell Grant or loans?
That's a very common and understandable concern. Generally speaking, external scholarships do not negatively affect your federal grant aid amounts. You should still receive your full Pell Grant eligibility, for example, in addition to your scholarships. Remember, Pell Grants can be used for a wide range of educational expenses, fees, books, supplies, housing, food, transportation, not just tuition. The key principle is that your total financial aid package, scholarships, grants, loans combined, typically cannot exceed your school's official cost of attendance, or COA. That COA includes tuition, yes, but also estimated costs for books, housing, food, travel, etc. As long as your total aid stays at or under that COA, everything should be fine. Your grants usually remain intact, and the scholarship might reduce your unmet need or perhaps the amount of loans you need to borrow.
So, if a scholarship specifically covers tuition, a Pell Grant could still potentially cover other things like housing or books, as long as you don't go over that total COA number. Is there a catch, though? I've heard terms like first dollar and last dollar scholarships. What do those mean? Why are they important?
Exactly, that's the ideal scenario stacking aid. However, there's a crucial distinction with scholarships, and this is where first dollar versus last dollar comes in. It's vital to check 2 things. First, ask your college's financial aid office how they specifically apply external scholarships. Second, understand the terms directly from the scholarship provider. This distinction could really impact your bottom line. Let me give you a quick example. Say tuition is $10,000, and you qualify for a $5,000 Pell Grant. A first dollar scholarship of $2,000 would reduce your tuition bill to $8,000 before your Pell Grant is applied. Your $5,000 Pell could then cover more of the remaining tuition, possibly leaving some Pell money as a refund for other expenses. That's usually better for the student. A last dollar scholarship, however, means your Pell Grant or other institutional state aid is applied first. So your $5,000 Pell reduces the $10,000 bill to $5,000. Then, the $2,000 scholarship covers part of that remaining $5,000, leaving you with $3,000 still to pay or cover with loans. In the last dollar case, the scholarship might reduce the amount of refund you would have gotten from your Pell Grant because the Pell was used up first on tuition. Understanding this term is absolutely crucial for budgeting.
That's a really important detail, and that example clarifies it perfectly. Okay, let's talk about student loans again, a necessary piece for many. What should we know about interest rates comparing federal versus private student loans? How do they generally stack up?
Understanding interest is vital, as it really drives the total cost. Let's start with federal student loans. Congress sets the interest rates yearly, based on the 10-year Treasury note. The huge advantage. These rates are fixed for the life of the loan.
So they won't change once you take it out.
Correct. That provides incredible stability and predictability. For undergraduates, the federal loan rate for new loans for the 2025-26 school year is 6.39%. For graduate students, it's 7.94%. And for PLUS loans, for parents or grad students, it's 8.94%. Federal loans also has small origination fees, a percentage taken off the top when the loan is disbursed. Now, private student loans, these come from banks, credit unions, sometimes schools themselves. Interest rates are typically credit-based. Better credit score usually means a lower rate, lower score, or no history. Higher rate, or you'll need a cosigner. With private loans, you often have a choice: fixed or variable interest rate. Variable rates can change monthly, quarterly, or annually, tied to market indexes. This means your payment could fluctuate, potentially increasing your cost unexpectedly. That's a risk federal fixed rates avoid. Most private lenders don't charge origination fees, but the interest rate structure is usually the more significant factor.
Given those differences, credit-based rates, variable options, when should someone actually consider taking out private student loans? When do they make sense?
Our recommendation is always to max out your federal student loan options first. Given the favorable terms, fixed rates, flexible repayment plans, and crucial borrower protections like income-driven repayment and forgiveness programs, federal loans are almost always the superior choice. Private loans should primarily be used just to fill any remaining funding gaps after you've exhausted all your federal options, including parent PLUS loans if applicable. Think of them as a last resort, not a first choice. If you do need private loans, shop around carefully, compare offers from multiple lenders, and strongly consider a fixed-rate option if possible, especially in a rising rate environment.
Okay, so if you already have student loans, especially maybe some private ones, are there effective ways to potentially lower your interest rate?
Yes, there are two main strategies people use. The first is refinancing. If you have good credit, maybe a few years after graduation with a stable income, you might be able to refinance existing loans, particularly private ones, to get a lower interest rate. This means a private lender pays off your old loans and gives you a new one. However, and this is a huge caveat for federal loans, if you refinance federal loans with a private lender, you permanently give up all those valuable federal benefits. No more income-driven repayment options, no more federal forgiveness programs, less flexible deferment forbearance.
That's a big trade-off just for a lower rate sometimes.
It's a very significant trade-off. You need to weigh the potential interest savings very carefully against losing that safety net. For private loans, though, refinancing can be a straightforward way to save money if your credit has improved. The second strategy is much simpler: automating payments. Signing up for auto pay for your federal student loans typically gets you a 0.25% interest rate discount.
Oh, really? Just for auto pay?
Yep. It's small, but it's consistent savings over the life of the loan, and it helps ensure you never miss a payment. Many private lenders offer a similar 0.25% discount, too. It's an easy win.
That 0.25% definitely adds up over 10, 20 years. What about paying interest while you're still in school? Does that actually make a meaningful difference?
It absolutely can, especially for those unsubsidized and PLUS loans where interest starts accruing right away. Student loan interest typically accrues while you're in school, unless it's a subsidized loan. When your loans enter repayment after you leave school, any unpaid interest that built up might be capitalized. That means the interest gets added to your principal balance. From then on, you're paying interest on a larger amount, interest on interest. It costs you more. You can save a significant amount over the loan term by making monthly interest-only payments while you're in school, or even just a fixed small amount like $25 if that's all you can manage. Or you can aim to pay off all the accrued interest during your 6-month grace period after graduation, before repayment officially begins. This prevents capitalization and keeps your starting principal lower.
So it sounds like while paying off student loans quickly is good, maybe prioritizing other financial goals first, like an emergency fund or high-interest credit cards, might be smarter in the overall picture.
Exactly. While paying off student loans faster does save you interest, other financial goals often take higher priority in a sound financial plan. Before you start throwing extra money at student debt, we generally recommend you first build a solid emergency fund, at least 3 to 6 months of essential living expenses. That's your safety net. Then make sure you're contributing enough to your retirement accounts like a 401k or IRA, especially if your employer offers a match. Don't leave free money on the table. And absolutely, pay off any high-interest debt first. Credit cards, personal loans, those rates are typically much higher than student loan rates and can be financially crippling. Once those foundational goals are met, then you can confidently look at accelerating your student loan payments if you choose.
That brings us to takeaway number 6. Scholarships typically don't negatively impact federal aid, but always understand their specific terms, especially first dollar versus last dollar. Prioritize federal student loans over private ones due to better terms and flexibility, and strategically manage interest accrual and payment, like paying interest while in school if possible, to save money long term. Okay, let's do a quick recap of our key takeaways from today's deep dive into the FAFSA. Takeaway number 1. Don't assume you won't qualify. The FAFSA is the universal key to federal, state, and school-based aid, including merit aid. Fill it out. Takeaway number 2. The FAFSA calculates your Student Aid Index, SAI, to determine eligibility for need-based aid like Pell Grants, FCR, subsidized loans, and work study. Takeaway number 3. Even without demonstrated need, federal options like unsubsidized loans, Bless Lows, and Teach Grants are available, usually with better terms than private loans. Takeaway number 4. Apply early after October 1st using official channels, studentni.gov. Review your SAR, and remember you can appeal if your financial situation changes. Takeaway number 5. The simplified FAFSA faced rollout challenges, so be diligent about avoiding mistakes, be patient, and communicate proactively with financial aid offices. And finally, takeaway number 6. Scholarships usually stack with federal aid under COA, but understand first dollar, last dollar terms. Prioritize federal loans, manage interest wisely, and handle other financial priorities first. Understanding the FAFSA and navigating the world of student aid can definitely feel like wading through a labyrinth, especially with all the recent changes and, frankly, the challenges in the rollout. But armed with the right knowledge and a proactive approach, you really do have the power to unlock significant financial support for your education or your child's education. What stands out to me after this deep dive is how these tools, despite their complexities, really do embody a long-standing commitment in our society to making higher education accessible. It kind of prompts us to consider how might these constantly evolving financial aid policies continue to shape not just individual academic journeys, but the very landscape of economic opportunity in our society for generations to come. That's all for now, folks. Please like, share, and subscribe for more like this.